Good morning, everyone, and welcome to the European crossover webinar. And we did get the data earlier for the Halifax housing prices out of the UK. I expect the Italian retail sales, as usual, those are running late. Those are never going to be on time. I mean, it's supposed to be released now, but as you know, they're always running late. And at 7 a.m. Eastern, we'll get gross fixed investment out of Mexico. And then, of course, as they like to call, or they usually generally refer to as the granddaddy of them all, it's going to be the non-farm payroll report. And the way this thing's been up and down, it's hard to say, what that amount is going to be, but there we go. See, the index has come off a little bit. Continue to slide here a little bit on NQ. We do also have Canadian employment, as well as IVPMI at 10 Eastern. And I'm just going and switch over to NQ. A little bit of slide back here. Pull that up. I'm trying to pull up that 30-minute here. Bear with me separately. Okay, there we go. And let's go on and switch over to there. So after a pretty good little move up, which I think probably knocked some people out of the box, here's the NASDAQ making that move here. Looks a little bit more dramatic on a very shorter time frame. I mean, this is on the 30-minute. But you can see here we made it up to this 13,620. Let's take a look at this on a... Here's on the 4-hour. Wow, I'll be doggone. All-time highs. Look at that. All-time highs we hit. And I am glad I didn't tangle with that cat yesterday. Other than some early scalping, and that was it. Kind of let them do what they wanted, and that was a good thing because, look, I'm surprised that it continued to move higher. Someone was asking me in the chat what it looked like going out in the extension. So what we did, we just ran, I said, probably because with non-farm payroll, they're probably just going to look at that most recent price range, which is right here. And when you pull that up, you can see 127% at 13,650 and 13,731. But they have a little run with this whole stimulus talk or going big with the COVID. But yeah, we did. Look at that. All-time highs. We hit all-time highs in the Asian session. Seen a decent little pair back from there. But you can see here, and I was a bit surprised that they kept it up here and kept it going. And here's as they went, and then they just basically squeezed these folks. Made a run up in here. Bitcoin went yesterday. We saw that went right to that key level, that 38,600. Remember, we talked about this 34, and I said, that would negate the downside, which we did here. And then when we shot up, where did we fail it? Right at the 38,600, because I said if we can get a 2-hour close above that, that'll open up the door and we're going higher. And that was on the Elon Musk stuff. And then we fell all the way back. To their credit, it actually came right back again. Now we failed here, but we're still, as long as we were above this 34,800, we've negated the downside. I mean, this actually here I thought, oh, this does not look good at all, the way that it failed. So that would have opened the door probably for us to go at least to the 27,820, if not probably down here to 24. The way it was looking, the way it ran up and then failed. But you got to give it to them. Look, in very short order, they've managed to get right back up here, challenge it. And here, that's actually quite bullish. But we still gotta get back up above 38,600. Um, oh, and I had not looked at that. He had asked about, someone had asked me also about what was my view on the ES, and I did go on and say I really don't pay that much attention to the ES. I mean, obviously it's still going higher, but let's take a look here. It looks like we did get to all-time highs and made it almost to that 38. It's something else. One of the reasons this slid here, I think this was this. Yeah, this was in Asia, because I remember even saving that at the time. It was. I think I read that yesterday too, here in the chat and the webinar. Those Chinese tech companies under some whatever issue, whatever, and that was actually what precipitated this fall right here in Asia. We dropped down here, and then boy, we saw that. So I was thinking, boy, that you think that would have kept the pressure up, and look, we just went right back up and made it all the way up to new all-time highs. So it'd be interesting to see how they trade it once we get past this non-farm payroll, because that doesn't really have as much impact. And if it's not like as if the report's bad, they're going to say, wow, we really have to do COVID. We really have to do this big stimulus. It looks like the Democrats are just going to go with that. The resolution where they'll be able to do the work themselves. I don't think you're going to get any much help out of the Republicans of any significance to the extent that they want to go or anywhere close to it. So that's where we stand there. We'll go and take a look at the FX. So bear with me. We'll do a quick review there. Or actually just go into the news and then we'll take it from there. So let's pull up. Okay, so the Aussie and New Zealand, Australian dollar. Australian dollar eases poised for a weekly loss, and the Kiwi down to, and that's what I'm saying. The other day I kind of had a little bit of a mini rant. Now, yesterday they were saying how they're doing so good because they had that differential with bond prices. Now, here it is 24 hours later. Now they're saying, oh, well, look, it's easing back. It's poised for a weekly loss. When yesterday they were kind of, trumpeting it up. So that's what I'm saying. It's like I don't pay too much attention to the news. But anyway, the Australian dollar slipped on Friday, was on track for a weekly loss, led by a pullback in global risk sentiment and on comments for the country's top central banker that interest rates will stay low for a long time. Now, the other day, now I will say it was focused more on the Kiwi, but they were just saying how things are looking good with risk and the bond differential, but with the U.S. But anyway, Australian dollar was last at 75.95, the Kiwi at 71.48. The Aussie is so far down 0.6 this week, while the Kiwi has lost 0.5 of its value. 0.5%, I should say, 0.5%. Analysts expect the currencies to meander a bit in this near term, led by better U.S. economic data in recent weeks, and with the fiscal stimulus set to provide additional support. The AUD has lost some of its luster in recent weeks as elevated, volatile, and softer industrial data look the wind took the wind out of the global reflation trade. We think the prospects of vaccine-driven recovery and policy that remains patient suggests the dips will be shallow. Earlier, RBA governor reiterated the central bank will keep rates near zero until inflation reaches its medium-term target of 2 to 3%. RBA this week left its cash rate at its record low of 10 basis points. Bond futures rallied on Friday with the 10-year contract. Yields on New Zealand bonds have shot to their highest since the market mayhem of last March at 1.41%. I will leave that. Dollar set for the best week in 3 months as the pandemic recoveries diverge. The dollar headed for its best weekly gain in 3 months on Friday, lifted by the growing confidence that the U.S. economic recovery will outpace global peers. Dollar index touched a near 2 month high in Asian trade amid signs of resilience in the labor market, with closely watched market non-farm payroll figures due later in the global day. The greenback has also renewed highs versus the euro and the yen. The U.S. economy is exceptionally strong relative to other countries, causing the dollar short covering, said Turo Sasaki. The current bout of dollar strength should continue for several weeks, he said, but the picture is murkier thereafter as Europe and Asia catch up with immunizations. And let's see, the greenback has been supported by the rise in long-term U.S. Treasury yields. And Democrats in the U.S. Senate were poised for the marathon vote session amid a overriding Republican opposition to Joe Biden's $1.9 trillion COVID relief. And that's what I'm saying is they're looking at doing it under resolution because of this. And so I think the Republicans were offering like 600 million, which is essentially going to be 1/3. So that's not even anywhere close. And they wouldn't even be happy, I don't think, with even half of that. Now, if it was maybe like at 1.3, maybe they'd be talking turkey at that point. So it doesn't look like anything. Analysts and investors are weighing whether the dollar strength this year is a temporary position adjustment after a 7% drop. There are potentially a lot of dollar shorts to cover, particularly against the yen. And there is another story that's a little bit more in depth on this, and we'll take a look at that since it's a relatively quiet day. With the exception of the Indian season, went to all-time highs. The dollar smile meets dollar short. Greenback bounces, threatens bears. An unexpected dollar bounce and some indication of a broader resurgence are confounding market players who took bearish positions on the U.S. currency on a bet that it was headed for a multi-year downtrend. Given the volume of global investment and commercial trade flows that hinge on the dollar's strength or weakness, getting the exchange rate correct is one of the most crucial calls a fund manager can make. According to the fund manager, the dollar could be about to conclude a trading pattern known as the dollar smile, which was in previous years preceded by major U.S. economic rebounds and currency surges. Put forward Stefan Yen, who runs a hedge fund, Yerzine. Looks like it's Yerzine. Maybe it's just Yerzine spelled incorrectly. But anyway, it holds that the greenback strengths in tough times, such as investors rush for safe liquid assets. The currency then falls as the U.S. Growth flags, forcing Federal Reserve cuts that led to the dollar lower, the bottom of the smile, before rising again. So this is what they're looking at. We can pop it open a little bit bigger. Okay. So what they're looking at, what they say is the left side of the dollar smile, global financial progress, financial crisis, and the dollar smile trough. Then the right side of the recovery, China slowdown, the dollar smile trough, left side of the dollar smile. I don't know. I don't get it here. Bear with me. Get rid of that. That wasn't clear. There you go. Let's move this away, other way. I guess it was supposed to be like this, supposedly, I suppose. I don't know. It doesn't make a whole lot of sense to me. At least the way it looks technically. Um, in the current cycle, Yen reckons that the first two stages of the SMILE formation are complete. The dollar index shot to a 3-year high in March 2020, and investors sought it out amid the pandemic-linked mayhem. It then declined, and the Fed slashed interest rates to zero, hitting a near 3-year low last month on expectations of ultra-easy U.S. policy additional borrowing. In the fast month, however, the gain back has jumped by more than 2% as a fast 20% vaccination campaign appears to signal the world's biggest economy will recover more quickly from COVID. My point has been that the U.S. would come out of the pandemic very strong, Yen said. That is being demonstrated very clearly. He predicts that the part of the SMILE is to complete when the euro falls to 113, a level unseen since last July. The euro then compromises 50%. We all know about that. What I'll do is I'll it won't be complete with this, but I'll probably print this up and post it in the room. So I don't want to stay on that for too long. And Irene says, can you please look at more detail at the euro dollar, please? And Richard says, good morning. Good morning, Richard. Yeah, we'll take a look at the euro dollar. Hang on. Let's get to that screen. And here we are there on the analysis. And let's jump on that to the euro. And if you think about this, I touched on this yesterday. This is the analysis we had over the last couple of weeks, because remember we were saying I don't use moving averages. I mean, I'll use the exponential moving averages on the 30-minute and on the 30-minute and also sometimes on the 5-minute. But anyway, that being said, so this is from the stocks that we were doing when I put the 20 and the 50. But what we found out, if you remember over the couple of weeks, I'm like, look how this thing's holding at the 50-day moving average. And we happened to look at that and we're like, oh, look at that. It keeps holding. It held here and it closed basically right there. And I said, wow, if we close below the 50-day moving average, then that's going to give us that trigger to sell. So we closed right there on the 50, and then we kind of held up a little bit. And I said, remember, this was part of the analysis. And I said, a daily close, we were looking for lower, but I said a daily close below 27.73 will give us that sell signal, straight up sell signal. Yeah, we're going to have it because with the 50-day moving average, because it looked like it was running out of gas, but to give a straight up sell signal is going to be 2073. We were just going by the levels. And I'm just going over this since Irene said to please go over it in depth. So that opened the door for us to go lower. And then, of course, we had the bias chart. And remember, we had it at, I think it was 2008 and whatever. And I mentioned in the chat room, wow, this bias chart's been on fire because the last prior 3 days, we hit the lows. We were within the lows between 1 and also 7 pips for the prior 3 days, which yesterday it was 1966, and that's where the bottoms, it did rally off of that. Now, eventually, I think we went to 1959, and we kind of came back up or whatever. But here's the deal. So Marina says, well, where it is looking forward. So I shared this in the chat room, and I posted this chart. Let's open this. Let's see here. There we go, maximum sell. Well, perfect. So I said, this is where I think we'll be heading to now, which was right there, which was, yeah, that's why I came up with the 1966, because I was saying, hey, look, I keep the analysis simple. I just go by levels, and when I use those levels, I just use the bodies. Y'all know that for you that follow the webinar. And of course, I'll look at wicks. So one of the things I was pointing to last, I did the analysis 2 days, or when the Asian session of the day before, I looked and I said, oh, okay, there we go. Oh, there we go. Looks like it's going to go to 1966. And that was actually the low intraday. And we popped off that. Now we came back, and then we dipped back, and then the low was it 1959? And we came back, or we held right there. So now I think in the very short term, although I think I moved a little bit lower, I said in the chat yesterday, I said, well, if we break, it's going to go to 1941. But here's what I think eventually we're going to, and I'll highlight that. Right there at 1870. You see that here? That's what I think, because you look at all the touches you see here. When you look at it, you're like, I don't see anything that makes a lot of sense. But then when you see it, you can see, okay, we run up here and we hold here. You see the high here, and that's what I was trying to do is like go as much confluence here. As many times as it's being touched is a significant. So look here, the high wick here, the high wick here. We finally get above it, but we close back. Look, we're trying to work higher. Wick, wick above it, wick, but the body can't get above it. You see that? A wick, we fall back, a wick, right to the thing. You see the 1870? So now you're starting to see this. Now you roll all the way back. We fall back to 1604. We rally it. And where do we run out of gas? Right there at 1870. Now we got a little bit above it. It was 1879. Give me a break, 9 pips. We roll all the way back. So you can see that's pretty good significance here. Look at how many times it's touched here. And when we rolled up to, we finally, as we came down to 1624, we rally. Look at this. It's essentially 250 pips. And where do we run out of gas? 1870. We roll all the way back to make new lows here. And we come back and where do we run out of gas? Well, it stops. Basically, the body stopped right at 1871. Okay. And then we dip back again. We did take it out, but notice that, look how we closed below the 1870. We closed just a hair above it, I guess it's 1873, 3 pips. Well, we fell back. Once we get back, where we run out of gas again, wicks. So now you see the significance of 1870. So I think eventually over time, we'll get to 1870. We'll probably, at that point, everybody's going to be looking for 115 euro, blah, blah, blah. So we'll probably overshoot it and we'll probably congregate the same way this has. So what you'd be looking for is an eventual move to 1870. But before then, I think today this is where I have support right there, whether we get there or not, which is right there. 1913, I might have put it like that right there, 1911. So that kind of gives us the overview of where I think we're going on that. But nothing changes. I'm still with I'm just using the buys and wicks. The difference is right now, you see the 25 across the 20 across the 50. So it's going to be on sell mode. So, hence you're going to have people that say, oh no, it looks like it's not going to rally. And people that are putting on brand new short positions. Because if you look here, where did it cross right down the wick? Right there on this bar. So new positions, and that way you saw the follow through. And you should still, doesn't mean we can't rebound, because the resistance today, going with just the touches, the levels, 2010. So that's today's resistance. So I think that'll be the resistance that the market would have to get above it. We need a close above 2010. It won't neutralize it, just take the pressure off a little bit. Not saying they're going to get there, but that's where the initial resistance would be. And eventually in time, I think we'll get to 1870. I don't think that's necessarily the big stop, but eventually that's what we'll get to. And then you can look by looking at where's the most significant low. Well, it'd probably be right here. You see here, even though we see we went lower and eventually went here. So you'd look back here. Let's do a, whatchamacall, a fib. That's a lot of significant low. And it's pretty significant. I'll come up here. So you can see we just came there to the 50%. You see there? So we just hit 50% back. So maybe with NFP, we'll kind of get a fight up in here. But that's a decent area for them to take a pause. If we don't rally off of this, then we can still go to the 61%, which would be 1888. And actually that you see here, there's 1870 there. If we were to rally off of this, which I don't think is going to be the case, but I mean, rally to get a good reaction, then the next fib generally is not going to where it's going to stop. It'd go much lower down. Not to say it eventually would go lower, but I'm just saying as long as we just kind of hold here or whatever, and we don't get a reaction off of the 50%, that should take us down to the 61%, which would be 1886. And remember, we're looking for 1870 and for a little bit of an overshoot on that. So hence, there we are. There's the overall look for this. So now to the analysis. Let me pull up the bias chart. Oh, Irina says, thank you. You're welcome, Irina. So here we go. The euro dollar closed sub 120 on Thursday. Friday support will be 1910. You saw where it came up with the 1910. See that? And resistance at 2010. I just let you know there. Okay. So that's the same thing. I'm not doing anything different. Here's the 1910. I look for the next key level or wick, key body or wick. Well, it's not here because look, we were going higher. You see, I think 1941 is key, but we do have non-farm payroll, so we may end up pushing the euro lower. So you look here, and after this rally, the market took a pause. It closed here and then stayed in a tight range, closed right there and opened it. So that would be the next area right there. And that comes in, hence the 1910. So it's 1910 on the downside for support. And on the upside, 2010 right there. Moving on to the cable. This cable's something else. I couldn't believe that they put a hammer in there. So the cable closed Thursday with a hammer. Resistance on Friday will be 37.26 with support at 36.15. So 37.26, 36.15. Moving on to the Aussie dollar. There we go. So the Aussie closed slightly lower in a tight range. Support on Friday will be 75.50 right there, just below these lows, with resistance at 76.59. So 75.50, 76.59. Still, obviously, still bullish. Onto the Kiwi. So the Kiwi closed into the key level of 71.50. You can see that right there. That's 71.50. You can see the body close here. And that's why I say it's so important. You see the body close here. Look what happens. A touch with the wick. A touch with the wick. Right here with the wick. A touch with the wick. So you can see the significance. So that's where I come up with those levels. Once again, say it ad nauseum, but I just go with the bodies. And then for additional resistance, I'll look for confluences with the wicks or significance, like I showed you with the euro at 1910, significance of, levels, certain levels with bodies. Okay, so anyway, enough of that. Support on Friday will be 71.06 with resistance of 72.06. Now you can see here clearly how the 50-day moving average is holding it up. Once again, I don't want to go with the flavor of the day for technical analysis or anything. It's not that's not it. It's just you have to see what the market is reacting to and just go with that. So, I mentioned that chat room also was that, hey, look, it just seems to be reacting to moving averages lately. It seem to be working really well since we're not really making any big moves. So you can see here, defended the 50 and once again, defended the 50. So, 7106 and 7206 for levels. Of course, with this being non-farm payroll, you could go by you can blow past these levels. Because of the volatility, but you know that these are the key levels to go and look at. And we haven't seen a lot of big I don't know why my stupid events, look at that went, oh no, it's not blank now. I thought it was. But we haven't seen like tons of volatility. So generally on non-farm payroll, I'll have, let's say, okay, here's 1910, and the additional support below that is 18, blah, blah, blah. We just haven't seen that much volatility. So that's why I'm just sticking with the one level on each of these and non-farm payroll. You can see we've been in tight ranges. So going on to the dollar CAD. So the dollar CAD closed slightly higher, but remains stuck. Resistance will remains 29.05 and support 27.65. So you can see here, we'll adjust this to 27.65. You see, and this should have been 20. It says 29.05, so I don't know why I said remains. So 29.05 and 27.65. Okay, now on to the dollar peso. So the dollar peso saw a short covered on Thursday. Resistance on Friday will be 2045 with support at 2026, which is kind of close to that 2023. But I'm thinking, I don't know if it's going to fall all the way back to 2023. But anyway, let's see, go back. Did they say 2025 or 2026? Hang on. 2026. Okay, there we go. Okay, the next one up, dollar yen. Dollar yen saw solid close above 442 or 542. Resistance on Friday will be 568. So far, the high today was supported 520. So high today is 563. But once again, with non-farm payroll, you got to look for a bit of a variance here. Could get past that easily. 520 on the downside. Onto the cash dollar index. The dollar index closed at the bias chart resistance on Thursday. Friday's resistance will be 91.73, with support at 91.12. Okay, on to the cross rates. QEN, no changes here. We're just holding steady here. So far, no changes. Just leave it as is. Next, euro pound. Wow, new lows here in euro pound. I thought this thing might have been able to hold. It's even gone even lower than that. This thing is something else. Of course, the euro's weaker. That's the reason why. So we may see this continue to slide further. So let's go into a weekly to see like where the heck are we. At this point, I was going to do a fib, but that doesn't make too much sense from here. Let's just see where that takes us. Well, you see, we've already fallen down to here. So we'd have to break way down here. So I don't think this is going to make any significance whatsoever. Hold on. So now we look for confluence here. This is the next key level right there. So it certainly looks like they're on their way there. That'd be 86.90. Short term there, you can see this body right there is 87.18. So we'll go with 87.18 for today. Although it does look like they're going to move a bit lower to 86.90. Onto the daily. We don't see anything to the upside. Go to 2-hour chart. And resistance would be right there. 87. Well, 58 is not very high, so it's going to be right there. That body close on the 2-hour. 87.70 for today. Onto the Euro odd. This continues to stay weak. We'll just go with the levels, and that is 56.96. Well, we did have it, 56.95. Upside, we had 58.23. Doesn't seem likely. We'll go with this lower body, which confluences with this wick. That would be 57.87. Onto the Euro Kiwi. Well, we tried to put in like a little mini hammer yesterday. What we're going to go for support is this wick right there. That's going to be the low of 2 days ago, which is 66.68. Well, that's where we are, 66.69. And the high is going to be this wick right there, which is where we're at, 67.58. I think we probably push a little bit higher than that. So let's look at the 2-hour chart, see if we can see something else there. Right there, this wick right there. 67.70. Aussie yen. No wonder. I was like, that looks odd. There we go. Aussie yen, daily. We're still stuck in this area. We're not going anywhere. No changes here in the Aussie yen. We haven't gone anywhere for the last few days anyway. Look at that. So let's move on to the guppy. Interesting. We're pressing up right against this big level. Look at that. The high is 44.96, 44.94, 44.94, and we're at 44.39. I mean, unless we take it up another notch, resistance is right now at that key level 44.47. The next one will be 44.94. And it's holding there. Well, to be on the safe side, okay, we'll go right here. 44.47.94. That'd be the next level. And support It's going to be right there, 43.47. Starting odd. Resistance is going to be that wick right there. Oh, that's where we're at. 80.22. I think we missed it by a pip. So 80.22. Support. Right there. See this body coming across here? That's 79.16. That'll be support. Actually, you see this body, confluence is here with this body. We'll go with that body open. 79.11. And that does it right there. So we'll get the, Amir says, can you look at a platinum? Oh, we did make that stand there. So right now, the key is this level here. Platinum's not, as liquid. So I would say we could look at a 2 hour to see if we see something before there. So let's see. Right there, that body. You see this body right there? Right there, that's resistance. 11.2480. Almost sounds crazy to say 2480 because look, platinum's not that. Now here's the deal. So resistance is right there. Let's just call it 11.2490, since it's 25. They're backing off a little bit. But we're going into today's Friday. So anybody that's short, they're underwater. So this thing's working against them. So you may retain a bid all the way to the close. But for right now, 11.25 is resistance for right now. And then, of course, this bigger level, which is 11.36. And with that, we'll call it a day, and we'll see you in the chat room. Thanks for joining us here on the European Crossover webinar.